Let me tell you something. Right now, somewhere in a major city, someone is refreshing their crypto app for the fourth time this morning. Heart rate a little elevated, hoping for green, praying it isn't red again. And across town, their neighbor is collecting rent. That neighbor is not on Twitter, not in any investment group chat, not watching any charts. They are just collecting rent every month like clockwork, while their property quietly gets more valuable on its own. Today, we are talking about the investment that has made more ordinary people genuinely, generationally wealthy than anything else. Not Bitcoin, not stocks, not get-rich-quick schemes or trading signals. Land, property, real estate. And before you say, I cannot afford real estate, stay with me, because that is exactly what I want to break apart today. First, let's be honest about Bitcoin. I am not here to drag crypto. The early Bitcoin story is real. People who bought in 2015 and sold in 2021 made life-changing money. That happened. But here's what else happened. 2022, Bitcoin lost over 60% of its value in less than 12 months. Now, if you are a professional investor with a diversified portfolio, 60% on one asset is painful but survivable. But if that investment is your savings, your child's school fees, your rent money, the pressure to sell becomes impossible to resist. And when you sell on the way down, you lose. Real estate does not do this. In over 100 years of data, across multiple countries and continents, land and property have never gone to zero. There have been slow years, quiet markets, corrections even, but the kind of collapse that wipes out crypto portfolios overnight has never happened to land. That stability is not exciting. But wealth is not built through excitement. Wealth is built through consistency. So, how does real estate actually build wealth? This is where it gets interesting because most investments work through one mechanism. You buy, it grows, you sell. That's it. Real estate works through 5 mechanisms at the same time. 1. The property goes up in value. This is capital appreciation. In growing cities around the world, land values have risen dramatically over time. Population growth alone makes this almost inevitable. More people chasing the same land means land gets more expensive. 2. The property pays you while it grows. A residential unit in a decent neighborhood can generate consistent monthly rental income, while the property itself becomes more valuable. Most assets either grow or generate income. Real estate does both simultaneously. 3. You can borrow to buy it. This one is powerful. If you buy a property worth $100,000 using $40,000 of your own money and a $60,000 loan, and that property grows to $150,000, you have made $50,000 on a $40,000 investment. That is a 125% return on your actual money, not 50% on the full value. In investing, this is called leverage. Used carefully, it is how ordinary people access extraordinary returns. 4. Inflation cannot eat it. Every year, money loses purchasing power. Cash sitting in your account loses real value even if the number stays the same. But your land? It is still your land. Its price adjusts upward as currency weakens. This is why people call real estate an inflation hedge. The asset protects you from the very thing that is silently destroying savings accounts. 5. The tax benefits are real. Property ownership in most countries comes with tax structures and allowances that can reduce what you owe. Depreciation deductions, mortgage interest write-offs, capital gains treatment. The specifics vary by country, but the principle is global. Real estate gets favorable tax treatment that most other asset classes do not. A good accountant will help you capture this as your portfolio grows. 5 channels, all running at once. That is why real estate builds wealth the way it does. Now, let us talk about getting in. Because here's the part nobody explains properly. Yes, prime property in the most expensive cities is out of reach for most people. Penthouses and luxury developments are someone else's entry point. But real estate investment has never started there. Entry point 1. Land and property in emerging areas. The oldest and most accessible strategy is straightforward. Buy in areas where development is coming but hasn't arrived yet. The outskirts of growing cities, emerging suburbs, secondary cities gaining population and economic activity. In many of these areas, entry prices are a fraction of established urban centers. The strategy is simple. Buy where the future is being built, hold patiently, and let growth do the work. This is precisely how middle-class families in the 80s and 90s became the landlords of today. Entry point 2. REITs, Real Estate Investment Trusts. Can't afford physical property yet? REITs are listed on stock exchanges in dozens of countries and are available through any brokerage account or investment app. REITs pool money from thousands of investors to buy and manage large property portfolios, office buildings, shopping centers, residential complexes. You receive dividends from the rental income, your share price rises as the properties appreciate. Real estate returns accessible for the price of a single share. No title deeds, no contractors, no tenant calls at midnight. Entry point 3. Cooperative and group investment. Pooling resources with trusted partners, colleagues, community members, investment clubs to buy property collectively. This model has quietly created property owners across every continent for generations. The key is structure. Written agreements, clear exit terms, transparent accounting. With those in place, a group of ordinary earners can collectively access real estate that none of them could touch individually. Entry point 4. Off-plan purchases. Many developers sell properties before they are built, at today's prices, with installment payment plans spread over 1 to several years. By the time construction is complete, the market price has often risen above what you originally locked in. You paid gradually over time, the asset appreciated the whole while. Now, the risks. And yes, they are real. Any honest conversation about real estate has to include this. Fraud and documentation failures are real. In many markets, people lose investments to fraudulent sellers, disputed titles, and forged documents. The solution? Never purchase land or property without proper legal due diligence, a qualified lawyer, a title search, verification of the seller's right to sell. The legal fees are modest. Skipping them can cost you everything. Real estate is illiquid. When you need cash urgently, you can't quickly sell a property the way you sell stocks. Real estate capital should be money you genuinely will not need for at least 5 years. Do not put your emergency fund into property. Properties need management, tenants, maintenance, repairs. Budget about 5 to 10% of the property's annual value for upkeep. Factor this into your return projections before you buy. Location is everything. Property in an area with no population growth, no infrastructure, no economic activity can sit flat for years. Study where people are moving. Follow infrastructure investment. Buy where momentum is building, not where it has already peaked. Here's the bottom line. Bitcoin might 10x in the next 2 years. It might also crash 80%. Anyone who tells you they know which one is coming is selling something. Real estate in a growing area, bought with proper documentation, held patiently for 10 to 20 years, managed responsibly, will almost certainly be worth significantly more than you paid. Not guaranteed, but as close to guaranteed as investing gets. And there's something else worth saying. There's a difference in what it feels like to hold each investment. Bitcoin is a full-time anxiety. Real estate is a background hum. You don't need to watch it. You don't need to be online for it. You can go about your life and let the asset do its job. The people who planted seeds in the right places 20 years ago are sitting in the shade today. The question is what you will plant for the version of yourself that exists 20 years from now. Start where you can, do your due diligence, think in decades. The best time was 20 years ago. The second best time is right now.
If this changed how you think about investing, hit that like button and subscribe. Share this with someone who needs to hear. What is your biggest barrier to real estate investment right now? Drop it in the comments. I read everyone.